Welcome, everybody. I'd like to welcome you all to today's webinar, and Fidelio is hosting a webinar on the attractive title of Pre-Empting Activism, the Role of the Board. And this has certainly been a title that's attracted a lot of interest and a topic that's attracted a lot of interest. And we'll explore during the course of the webinar why that's the case. And we'll also do some sort of definitional work, because I suspect that's going to be an important element here. So if we could click to the next chart, please, Belle. I'm really pleased today to be joined by Cas Sydorowitz, who's the Global Head of Activism and M&A at Georgeson, as well as my colleague Steve Cheetham, who's a former investor and sell-side analyst, and will bring the view of the investment community to this discussion. The topic's a really important one, and if we could click to the next chart, please. Today, we have quite an ambitious agenda. First of all, we'll start off with what we're seeing in the marketplace in our work with boards vis-a-vis activism. We'll then look at the investor perspective and how investors think through the role that activists play. And then Cas will share with us a view from the market, and we'll take the opportunity to look at the activism playing field, what it looks like in 2023, expectations for the AGM season this year. And our landing place will be how boards can preempt activism. So that's where we're taking this discussion. But in the meantime, we'll also leave plenty of opportunity for questions and answers and discussion. And so it's really an opportunity for practical issues to be raised and thought through. I should say this is being recorded, and we will share the materials with you afterwards. Thank you. Now let's move on to the next chart. And really, before we dive into all that material, I'd like to really turn to you and see what you think about activism. And so I know you could very easily make the case that activism is both a constructive force in the capital markets and a major disruptor for corporates and boards. But in this instance, we're really pushing you one or the other, a force for good or a force for disruption. So if we could open the poll, please, Amy, and if you could kindly allocate your vote, either that activism is a constructive force, A, or a disruptive force, B. Sadly, we can't vote on this one, so participants. Well, thank you.
That's surprising.
Exactly.
Quite narrowly balanced there.
Almost a Brexit vote. But there we go. 53% think it's a constructive force and 47% a disruptive force. And that's quite interesting. I had felt it might be the other way around, but we'll open up for debate on that. So thank you very much for your votes on that. And moving to the next chart, I'd like to just share with you what we're seeing in the market vis-a-vis activism. But perhaps before I do, just a word on definitions. When we sent out the invitations for this webinar, I was a little surprised to receive a very strong response, really saying, well, boards shouldn't be trying to preempt activism. Boards should be really listening to what the activists have to say. And I don't think for a moment that we're saying boards should ignore activists. Absolutely not. But I think our starting point was really financial activism. And we completely see that there are other aspects of activism. And I think one of the themes today will be how those are interweaving. And if I'm sure for all those on the call, you're probably thinking about the recent sort of Client Earth case that's been brought against the directors of Shell, and indeed against the financial regulator in the UK as well. So we recognise that there are many strands of activism. Preempting doesn't mean ignoring, and I think let's explore that as we go through this call. Firstly, what we're seeing, we certainly see that the activist agenda very often coincides with the board agenda, or bumps up against the board agenda. We've conducted board evaluations where activists care about the board and have a seat on the board. We've also conducted evaluations where activists are very much on the horizon and shaping, influencing the board agenda. On the composition side of our work, clearly activists care about board composition. Sometimes they'll have a seat on the board, sometimes they'll propose an alternative slate. And I think that's one of the dimensions of, the board is absolutely focal to activist attention. And, getting that alignment will be really important between, your objectives, your strategic goals, and the composition of the board. And then finally, on the development side, we are certainly seeing boards upskilling vis-a-vis capital market skills. Partly there's a broader picture here about valuation, capital structures, but activism is one piece of that. And we're seeing boards both in terms of composition, but also in terms of learning skills and development, making sure that they're really firmly on top of capital market activity, etc. So we're seeing actually activism influencing and shaping composition and effectiveness and the board agenda in a number of different ways. And I'd now like to hand over to my colleague Steve to share with us really from an investor perspective. And I should say we debate quite a lot internally. What is activism? What role does it play? The question that you started with on the poll. And Steve and I come at this from slightly different angles sometimes. But Steve, if I could hand over to you, please.
Thank you, Gillian. Yes, well, from an investor perspective, I think the first thing to be said is that traditional, that is financially focused activism is very seldom harmful, because most activists' interests are aligned pretty much with those of the other shareholders. So as an investor in a company, you can be actually quite pleased if an activist pops up and starts agitating for better returns or for changes in capital structure, etc. I think there's a bit of a rider on that, in the sense that some activists do use pretty complex derivative positions, which may mean that their interests are not entirely aligned with those of other investors. But from an investment perspective, traditional activism is very seldom harmful, and indeed in most cases marks change, and marks change for the better. Activism is also becoming, I think, increasingly important because we live in an increasingly passive investment world. So by some measures, passive funds are already over half the market. And there's an interesting theoretical question as to how many active managers are required to set the right price for a share. But in the interim, activism and activists provide a welcome dose of analysis and of push towards increasing shareholder value. So again, a positive thing. In parallel with traditional activism, we're also seeing environmental activism, which, as Gillian mentioned, provides an extra layer of challenge for boards, but is focused very much on aspects of climate change mostly, and is really to be seen, I think, separately from the type of activism we're talking about today. Nonetheless, ESG performance and reporting for companies is an increasing focus, and that sort of overlaps with activism in a number of ways. ESG investment for investment firms is a really important trend. It's one where I think most investment managers would like to make some money, would like to justify some fees. And it's becoming really very germane given the introduction of the EU's SFDR, which, like it or not, is going to deeply influence the classification of funds and the extent to which funds gain assets under management. And I should say, you know, as an older person, it's very interesting talking to younger people about their investment plans. And ESG is very much a focus of ethical investment. Certainly talking to my kids is a big deal. And I think for the industry generally, they're really having to focus on ESG performance because they're not going to get the funds otherwise. And in parallel with that, most asset managers we talk to, and we've talked to quite a few recently, are choosing engagement over exclusion. So in the context of ESG, very few firms have got blanket exclusions by sector. They're preferring rather to talk about improvement, to talk about plans. And the final point, which I think Gillian already mentioned tangentially, is the impact of what we're calling the end of free money. Interest rates have gone up. The corporate capital allocation process has, over the last 10 years or so, has been deeply impacted by the fact that money has been very cheap to borrow, which has increased the attractiveness of highly leveraged strategies. And that has driven portfolio structures which, in the light of higher interest rates, are likely to be less value generative for shareholders going forward. And I think we're seeing a lot of boards looking at their portfolios going, well, actually, we better review this. And of course, that links to activism, because one of the standard prescriptions in the activist playbook is get out of the businesses where you're not strong and focus on the stuff you know you can do well. So we expect activism to be driven by a kind of reconsideration of capital allocation strategies, given that money is no longer free. So I hope that's a useful introduction, and I'll pass back to you, Gillian, for the next slide.
Thank you very much, Steve. Thank you.
Gillian, can I ask, could we just go back one slide to Stephen's? I just wanted to make one point that he mentioned, which I think is relevant for this audience. And it's the second point. Activism is vital as in an increasingly passive world. There is a trend at the moment for index managers to pass on the voting rights to their underlying clients, whether those clients be institutions, pension funds, insurance companies, endowments, or even retail shareholders. And the relevancy for all corporates is that the asset managers, those big three index managers, BlackRock, State Street, and Vanguard, will likely vote less shares than they own and they manage on behalf of their clients. The relevance for activist situations for this subject, today's panel, is that previously companies could rely on BlackRock and those other two to support management, which they've done to the largest extent. If they're voting fewer shares than they own on the register, it means that there's other people who may be influential and be more critical of companies. So I just think that is one to keep on our radar screen. It's not one that is likely to impact us in the 23 proxy season. I do think it's going to have a more meaningful impact in the 24 proxy season, where if BlackRock owns 8% of a company stock, maybe they're not going to vote all 8%. Maybe they'll vote 6%, and that their institutional clients and even retail clients below the other 2% will exercise their views and vote for those other 2%. So I just think it's worth noting.
It's a very important point. Thank you, Cas, and thank you, Steve. Could we move to the next chart, please? And really coming to Cas, I wonder if you could just take a step back, Cas, and sort of building on what Steve said, where are we today in terms of activism? And then we'll come to the AGM season and some learnings forward. So, Cas.
Thanks very much. Activism as a label, as an asset class, is quite broad, and it includes what Stephen talked about, the traditional activists who are focused on financial returns, but increasingly it's including NGOs who have a single focus on some issue, whether that's environmental or social, and many of the NGOs that certainly in a UK context, names such as ACCR, Market Forces, Follow This, Share Action, Climate Action 100, don't necessarily own shares themselves. They are looking for support from their signatories or supporters to apply pressure onto the companies that they are targeting. And that's another form of activism. And the investors who are supporting those NGOs are the names that are already on your register. Those are names such as Aviva, Mundi, BNP, and the like. They're joining forces and supporting these campaigns, even filing resolutions themselves. Elgin, Legal and General Investment Management, filed a proposal earlier this year at Glencore. So we're seeing traditional investors stepping into the breach and applying pressure to companies. So it's not only the traditional activists, names such as Elliott, Third Point, Tilios, and others, but it's a much broader array. I would add to that, and this is becoming increasingly important, which is short sellers are becoming more prominent. And it's not only the Muddy Waters of the world, but there's a growing community of short sellers who are putting pressure on companies and doing extensive research to justify their claims that whatever the argument is, that either the company has misrepresented themselves. In a prep session, Stephen talked about, if you're selling apples and the company is not producing apples but is producing oranges, these short sellers will produce and find out that through their research that it's not an apple, it's an orange. So short sellers are very important in this discussion. You deal with them in a very different way than you deal with many of the other types of activists, but one to keep on the radar screen. It's not one that's kind of easily forgotten. And I would also add that there is an emerging community of ESG activists who are out to make money for themselves. And there's a couple names in this category: Clearway Capital in Germany, Bluebell Capital in the in the UK, Impactive Capital, who are going after companies, trying to act as an impact investor, creating change and creating value for their own clients at the same time. That's a dangerous space, because some of those individuals, some of those activists, can apply pressure without owning a huge holding in a specific company. Bluebell ran a campaign at Solvay, a Belgian chemical company, with one share. And after a year and a half, almost 2 years, the company and Bluebell came to an agreement in September of last year, issued a joint press release, kind of declaring truce and allowing the company to kind of articulate what they were going to do in terms of addressing some of the environmental challenges that Bluebell had. And that pressure came on Solvay not through the one share that Bluebell owned, but through politicians, regulators, customers, at a local and an EU level that was significant enough to get Solvay to the negotiating tables and even to concede on certain points. So just be aware of that. The size of ownership is not the determinant factor on whether or not an activist will be successful.
Thank you, Cas. I mean, that's set quite a rich tapestry of and an interwoven tapestry of activism. If we look ahead to, you talked about the 2024 AGM system, but coming back to this year, what are you expecting to see as priorities, and the extent to which that dovetails with activism?
The UK market is squarely in the radar screen of many traditional activists. They are looking at valuations, the UK market and stock prices as a result of a post-Brexit economy, a post-COVID economy, rising interest rates, the challenges that companies face in terms of rising financing costs that Stephen talked about before. All of those issues will create targets for traditional activists to create economic value, for companies to justify or to address underperforming assets, non-core assets in a direct way. And the key issue, I would suggest, is the time horizon on some of those issues. So we could easily see a number of traditional activists putting pressure on companies to address portfolio businesses, capital allocation in terms of share buybacks and the like. We will also see, yesterday there was an article in the Telegraph talking about forever chemicals. And while that focuses on the chemical sector, there is a growing interest in institutional investors to examine not only the human capital, but the natural capital side of chemicals. And, forever chemicals don't degrade. Shareholders want to understand what companies are doing to stop production, how to address those chemicals that are already been produced, and how to clean up any waste that's necessary. And I think I asked an investor this morning about this and why this is gaining momentum. And the answer was that it actually addressed two different factors. It's not only environmentally driven, it also has a social impact, because what are the chemicals doing to the human beings, to the planet? And so it's addressing both. I think we will see more NGOs focus on oil and gas, chemicals, and mining companies in terms of the production and taking coal out of the ground. It's going to be, I think, an active annual meeting season.
Thank you. And just maybe opening up slightly, and any differences, you talk very much in a UK context, and I think most of our listeners are from the UK, but we do have international listeners as well. Just any other observations internationally on the AGM season?
I think perhaps not so much from a UK perspective, but board independence and board access. So there's a well-defined structure in the UK of shareholders being able to access the senior independent director. That same model, that same access isn't as widely available in some other jurisdictions. So I think they're, something to consider for other board members on the call, that access to shareholders and getting a view from the investors is quite critical, because and if an activist comes after a company, you can be assured that they will be as prepared, if not better prepared, than many of the board members on the company that they're targeting, in terms of knowledge of the sector, knowledge of the company, and the drivers of value creation.
Thank you. And coming to my final question, which is really the sort of the theme of today's webinar, how can boards preempt activism? You've set the landscape, you've identified topics. I'm going to ask Cas and then Steve for your 2 or 3 sort of real practical tips as to what boards should be doing to preempt activism. So Cas, starting with you.
Certainly. Well, the first point I would just suggest, and we see this very often with short sellers, when a short seller comes out with a research note, usually the first thing the company does is immediately reject the claims and say, it's patently untrue. And instead, I would suggest this suggestion is relevant not only for short sellers, but for other activists. And very infrequently do we see this. Companies put a press pause, and having received a letter, having received either public or private a demand from an activist to say, thank you for this, we value the views of all of our shareholders, let us do our own research on what you've just shared with us. It's not going to be overnight, it's going to take a little bit of time, but we're keen to understand how you've gotten to these. Too frequently, most companies pull up the ramparts and pull up the gate and just immediately reject the claims of the activist. An activist spends a huge amount of time, both internally and externally, to understand what the value drivers are and what may be impacting a company. So one is pushing pause to understand and analyze the demands of the activist. The second point I would suggest is having boards listen to their shareholders. Now, that may happen directly, it may happen through management and the IR team, but getting a view from the shareholders can be quite informative, because if the perspective is one whereby the activist already has a sizable level of support from the investors, and that's not understood at the board level, going into any negotiations or any discussions with the activist is going in without all of your tools available. So making sure that the board is fully informed of the views of their shareholders. And that may be difficult to obtain from the management perspective, because there's a bias there. but it's incredibly important, and we see that very frequently where a group of shareholders is wholly supportive of an activist's demands. And the last point I would just mention is assess who the activist is. Some of these activists, certainly on the traditional side, may be opportunist and not long-term investors. You could put certain names against that short-termist category. It doesn't mean they're not effective or not impactful, but there's a very different model for a Sevian or a Value Act, which is two on the other extreme side of value creating activists, to understand what is their objective and the time frame that they're looking for you to make change within. A Value Act in Sevian is looking to partner with the company in many respects like a private equity company, a private equity investor would, different than a traditional investor who may be looking for a 1 or 2 quarter presence on the register and then move on. So I just think kind of understanding that activist profile is as important. Stephen, I don't know if you have additional thoughts there.
I would echo everything you've said so far. I mean, I would say you're just going in, and the most important thing you can do as a board, I mean, as a company, your best defense against an activist is strong profitability and a good high share price. And if you've got those, then you don't need to worry about anything. Now, clearly, many boards think that the share price doesn't reflect the underlying strengths of their business. In that case, what you have to do is communicate and communicate consistently over time the financial performance of your business. And I think in parallel with that, I would echo something that Cas said, which is that activists are typically very well prepared. They typically have teams of analysts who know their stuff. And I think all companies have a need to analyze their peers, and this doesn't need to be a very labor-intensive operation, but you need to understand how your financial returns relate to those of other companies in comparable businesses. And if you don't know that, and you are not able to explain why, for example, your return on equity is lower than the competition's, then you're laying yourself open to activism. I'd also echo the point about engagement. Too often when we see activism, whether it's long side activism or short sellers, the initial response from companies is nearly always want to pull up the drawbridge. And from an investor perspective, that is not the smart way forward. The smart way forward is to engage, is, as Cas said, to understand what the other shareholders think. You know, is this activist a mad person with a minority view, or are they actually reflecting what many of your investors actually think, but are too polite to say? And you can see a number of situations like that. And the other point about engagement is perhaps more subtle, and I think this moves on to the idea of giving the activist even a seat on the board. Outside a company, it's very easy to focus on the financial upside and the analytical case for improvement. If you're inside the company, you know all the difficulties, you know all the stuff that's stopping you doing things. So in a way, the big hug strategy of engaging and putting your activist on the board acquaints them with the reality of running the business, which is typically harder than just sitting outside it criticizing.
Thank you. Now that's a bold step, but certainly, you know, the activist on the inside becomes a director, subject to director's duties, and that can be a very different vantage point. Now let's open up to questions. We're getting questions, and if anybody has questions, please just use the Q&A function, and we'll leave the screen up actually. And Belle, fine, oh, we've dropped it. That's fine. So the first couple of questions relate to short selling, and really talking about how does short selling and some of the practices you described, Cas, how does that not fall into the category of market abuse? And then the rather sort of the assertion a short seller is not an investor. So I'm going to turn to Cas to address those two questions.
Sure. You're right. Often a short seller isn't a direct shareholder, but they do have economic exposure to a company. And not always, but many of the short seller research houses also have investment arms or partners who are short a stock. They produce their research with the expectation that it will drive the share price, and they will make money if the share price goes in the direction they expect. Um, they are the reason it's not market abuse is because they've done extensive research to uncover something, and I suppose there's a gray area whether or not you should be able to publish something and have that type of impact. But in a world where social media, whether it's Reddit in the United States or other tools, are so widely available, it's hard to kind of police and stop people expressing themselves and providing views. A short seller differs themselves by spending a huge amount of time researching something and evidencing their claims as to why something is the way they say it is, and how that's different from what the company says. So it's a more informed view, and most short sellers, at least the reports that I've seen, have very extensive evidence backing up the claims that they've made.
Thank you. I'd now like to move to our next question, which is, I think, a question that's close to my heart, and I'd like us all just to comment on it. This is a question from a board member who's has experience of sitting on a board with a very disruptive activist shareholder, interested in short-term gain rather than long-term shareholder value, and using PR and communication in what was perceived to be a very manipulative way, leaking sensitive information, for example. And so I wonder if we could talk a little bit more explicitly about the communication, in this case, the use of PR on the part of the activist. Can I start off with Cas and then turn to Steve?
Sure. It's super interesting because most activists I know have kind of PR firms on retainer, or engaged for specific campaigns, and the work that they're doing for the activists is to help them achieve whatever that initial change is, i.e. getting on the board or getting the company to do an increased share buyback or increased dividend. It's usually, not always, the role of the PR firm to get them to that point, not to then support them kind of in a disruptive manner. Of course, it can happen, and I'm not denying that this wasn't the case with this question. It's odd, and that I think starts to migrate into the area of market abuse, because the director's duties and how that information is getting into the public domain, and which PR firm is being used to leak that to the different journalists is quite problematic, and also I would say not something I see very often.
Thank you. Steve, any comments from your side on the PR aspect? It might not be.
I would pick up on what Cas just said, which is it's very understandable that companies feel in many cases unjustly targeted, particularly by short sellers. But if you look at the cases where this sort of thing has happened and where there have been major PR battles, I think you will conclude that for the most part, the short sellers had the best of it, in the sense that the most obvious case we've had recently, where it did get very, very dirty, in inverted commas, was Wirecard. And there's all kinds of PR was going on, and there was all kinds of, potentially, if you believe the FT journalists, there was a lot of intimidation going on by the company. And I would just highlight the fact that ultimately the response of the company was not helpful, and was not successful. So I would flip that around for a board and say the most important thing you can do in this arena is to have a narrative and to own that narrative. And if you don't do that, you're leaving, obviously, an open route for an activist or a short seller. But if you're communicating proactively with your investors, you have a strong story, and your story is backed up by numbers, then investors will listen to you. They won't listen to somebody who's attacking your numbers or whatever. And the final point I'd make about short selling, which I do feel very strongly about, having broke to a number of short sellers, is that short selling is not an easy way to make a living. If you ask somebody like Jim Chanos, who's one of Kinnikos, now rebranded, but one of the best known short sellers, Jim would always say, look, this is a hard way to earn a living. It costs you to short a stock. It's a painful process. Normally, shares go up, and that means that the dice, in many cases, is loaded against the short seller. So I would just say the short sellers perform an extremely important function in capital markets, and it's not an easy way to earn your crust.
You can see the healthy debate we have within our team about the role of activism and short selling. But I'd just like to sort of perhaps add a couple of words on that PR point, because as I think the person who raised the question flagged, I've headed global investor relations for what was then the most shorted stock in Europe, so have been sort of really at the coalface on these issues. And I'd say a couple of things. One, I think it's almost too late if you're already in that kind of firefight with the activist, or this is something that needs to be thought about. Our title is Pre-Empting Activism, and this is something that boards can do now, whether they're in a bad place or a good place. Ideally, when they're in a good place, make sure that you've got a strong equity story. Make sure that you've got good communication channels. If you're a larger company, a good IR team, a good comms team, and that they're joined up. And that you really are comfortable that you've got good people engaging with the market, and that you, the board, Cas's point, are also have your channels to the market and are aware of what key stakeholders are thinking. And I think that would be perhaps my message. In good times, get all this in place, because it will serve you very well in bad times. It's much more difficult to get on the front foot. And I think the other point I'd say is expect activism. It happens to many companies, so just expect it as a board member. Make sure that you've actually got a strategy for how you're going to deal with this. Thank you on that point. We've got another excellent question from a slightly different angle, and I'll start with Steve here. So Steve, you mentioned very clearly the best defense is strong profitability and a good share price. How does that work in a case where the basis of activism is linked to ESG, so environmental issues, for example? And I'll come to Cas on this one as well. So how do we square that particular circle? Steve?
I think it's actually the same process with slightly different inputs. If you're, for the sake of argument, a chemical company, you need to have a very strong story about your environmental performance. You need to be clear that you're not discharging toxic material, that you have a plan to reduce the environmental impact of your operations, and that you have thought deeply about the environmental challenges of your business, and of the ways in which you might mitigate those. So I think it's entirely the same. It's the same narrative, sort of narrative, as an equity story, but you have to be able to demonstrate to the activist that this isn't new news, that you've thought about all of this, and you're already doing what is reasonable. And we can obviously, you can have a discussion as to how far and how much money you want to spend, but that you have a coherent story. And I can't stress too much, the best defense is a coherent story backed up by numbers.
Thank you. And Cas, your observations on activism coming from a different angle.
So what's very important as we talk about ESG issues is that there are often very significant transformative steps that perhaps a company may need to take. And I don't think institutional investors or even NGOs are looking for companies to kind of turn a corner immediately and say, next year we're going to do X or whatever their challenge is. There needs to be a game plan and a time frame within which a company addresses these material and ESG risks. And I think part of the challenge here is with traditional economic activists, there's often a kind of immediacy of demand or time frame that the activist is looking for the company to respond in. When we're talking about ESG issues, there usually isn't that same immediacy that exists, and the company's requirement is, one, what are those material risks, and over what time period? So the company has some level of input into that time frame. It's not always set by either the marketplace or the ESG activists. And where will the company get to within X period of time? And they have the luxury of being able to set what X equals. So I think there's a different immediacy and time pressure on ESG issues versus economic issues that a company should just consider. And you also have, the ability to help create the framework that you're working within.
That's a very good point that you make. And I think the sort of the uncertainty between, if we look at companies will be publishing their transition plans this year, and the uncertainty that's sort of inherent in the road to net zero, it's going to be rife for opportunity. And we haven't even mentioned greenwashing, but that's obviously a really important area, sort of building on what Cas was saying. And I know we recently did some work with Chapter Zero and with Brunswick, thinking about what board members can be doing to ensure that there's integrity of communication. And very often, greenwashing is, I mean, sometimes it may be intended, but very often it's absolutely not intended. And I think this is an area where board members do need to come up to speed, to put in sort of place the checks and balances, so that claims that are being made to the markets or claims that are being made to consumers reflect the reality of, where the company is. Equally, that companies become good at communicating what does uncertainty mean and how they're navigating uncertainty. Now, we've just had another question. I wanted to just make sure that we have time to address that. No, it's just somebody's kindly sent through a link on Wirecard, and we'll absolutely include that in the material that we send through at the end of this course, so that you've got all the references that are being made. Can I come back to a point, Cas, that you made, which was about the asymmetry of information? I mean, to a certain extent, I think board members, non-executive directors, find themselves in a position of asymmetry within the company anyway. That will be the executive directors that have the information and the insight. But equally, vis-a-vis, if they have an activist on the board or an activist at the door, that activist may have access to very detailed information that non-executive directors don't have. Can you just talk through how that plays out, and any thoughts you have on how non-executive directors can deal with this asymmetry of information, which is inherent, I think, in the role?
Sure. I have a great anecdote that touches this point. So many years ago, we worked for Knight Vinke Asset Management. So they're not as present in today's environment, but they had gone after Carrefour. And one of the arguments that they made at Carrefour was that their big box warehouses were not creating enough value for the company. And so they had gone to, I think, 46 different locations where Carrefour had. They measured using laser measures of how much of the square footage was allocated to food versus non-food. They put stickers on material goods. So the example they gave was on bicycles that were on display, and whether or not they were moving. They would come back a week later and see if the same bicycle, the same sticker was there. And so they were trying to stress test the movement, the traffic that was going through these stores, and make their own assessment versus what was being fed to the marketplace and the company. So it highlights the asymmetry, because what non-executive director is going to do the same type of work and hire external consultants to help them do some of this. That's what goes back to that very first point about pressing pause. If an activist comes to you and asks for change and presents to you a case or a thesis that more could be done or there was change warranted, because often they've done that type of very detailed analysis, investigation, site visits, and so forth to help inform their view. And absent that, the board could be making a decision about something without having all of the facts. And so I think, it's very important to create the space and time to allow a board to make their own independent assessment without criticizing the activist. The last point I would just make is that activists don't make money by getting one of their people or someone they've recommended onto a board. They make money when the share price appreciates. And, activists make a significant amount of money when that happens. And so the end game is not getting someone on the board. It's about what that person on the board will achieve in terms of capital allocation or change or divestment.
Yeah, absolutely. You can see that recently with Disney and Nelson Peltz. The minute Disney started doing what Nelson wanted, he said, okay, you're now doing the right stuff, so I don't have a proxy fight anymore. Yeah.
Can we just talk a little bit about, and we are sort of running out of time, but I'd just like to come to that point of composition. Now, one of the strategies is for an activist to gain a seat on the board. It's a means to an end. It's not an end in its own right. Another strategy is to really challenge the composition of the current board and potentially to put forward an alternative slate. Can you talk a little bit, Cas, about the activist approach of challenging certain board members, which board members are typically most vulnerable, the success of those type of actions?
So some of the things that are critical for proxy advisors, right? ISS and Glass Lewis, when they assess board members, when they come up for election every year, they're looking at tenure, they're looking at their age, they're looking at their overboarding capacity. Those are the same issues that activists look at because they're trying to create arguments that will be pliable amongst the institutional investors as well as the proxy advisors. They will look at share ownership, right? Do they own, one of the interesting things that Nelson Peltz said in the Disney proxy fight is, if I get elected to the board, I will own more shares than everyone else on the board collectively, right? So, that's a powerful statement. That's an issue. What is the share price done and the performance of the company done over the period that these board members have been there, even though an individual board member may not be wholly responsible or directly responsible for the share price performance. It could be a macro issue or a number of other issues that is affecting the share price, but that doesn't matter. The activists will point to that and say, look, this person presided over in the last 3, 5, it's probably not 3, it's probably 5, 7, or 9 years, and the share price performance is languished. It's only gone up 2% or whatever the augmentation has been. So I think those are some of the key things that activists are looking at. And I think the board assessment that you mentioned before, Gillian, and how the interaction amongst board members becomes so critical in any defense that a company and a chair mounts against an activist, because it's the dynamism of the board members, that interaction that creates the power of the board and sets the direction going forward. So success amongst that is overwhelmingly more powerful than any criticism of an activist saying, you sit on too many boards, or you've missed 3 board committee meetings over the last 12 months.
Thank you. We've had a question which is a perfectly valid question. Is it a sort of a blessing or a curse to be approached to sit on the slate of an activist? So as a non-executive director, what sort of risk are you taking? So I think this is probably one for Cas, and then perhaps I can say a word as well, but Cas.
Sure. So again, in this situation, understanding who the activist is absolutely essential. If I personally was approached by Sevian or Value Act to represent them on a board seat, I would view that as an honor and a privilege, and would probably jump at the opportunity. If another activist from the U.S., not only the U.S., but I'm thinking of one in particular who was particularly difficult and cantankerous, ask me to represent them. There's not a chance in hell I would ever represent that that firm, just because I don't trust the activists themselves. They don't
I hope they're not listening. I'm
they
sure
don't behave themselves in a professional manner. So it all depends. It can be an honor. It all depends on who the activist is.
Thank you. And I think I would, just reiterate that kind of doing one's due diligence, and it is possible to do due diligence. Situations vary quite a lot, and we've also worked in a context where we've seen actually quite constructive input from activists. There's a wide field, as Cas says. So not being black and white on this situation. I'm keeping just a little bit of an eye on the time. I've got a couple more questions coming through. Let's just see. We've just had a question about whether we could provide the names of activists, but we'll provide the recording of this call, and I think that would give you some context on the activists that we're looking at. And I guess just a final question on my side. We've talked a lot about in ESG, and we've talked about the governance, and I would agree that we do see boards very actively using the governance measures of evaluations and good practice as part of their sort of the statement on G, and that is acknowledged by ISS and the proxies. But the S, can either of you perhaps just shine a light on where the S comes into activism? You talked a little bit in the example you gave, the chemicals example you gave, Cas, but any thoughts on the S, either Steve or Cas?
Cas, go for it.
Sure. Human capital is probably the most prominent S component that companies will face. Certainly in 23, we've come through a very difficult time because of the pandemic. How the senior executives have treated themselves, both in terms of remuneration and kind of how the company's performance done versus what have they done for their all employee base. And as inflation bites and hits many the common workers, if there's a disconnect between how the senior execs are treated and dealt with versus the staff, I think that will highlight a potential risk. And in different jurisdictions, you have other concerns that are coming into play in terms of diversity and how companies address that on not just gender diversity, but a wider array of issues. Companies are required to, or becoming reporting on these issues and statistics, and investors are looking at it and they're starting to ask questions. Thank
you. Yeah. Steve, I don't know if you want to add anything on.
Yeah, but very much so on the social thing. I would highlight the role of the non-executive director with the responsibility for employee engagement. I mean, there's a very clear mechanism on this set out in the code, and I think that's a very important role in the board, particularly for those businesses that have large numbers of people. And where recruitment and retention can be a major issue, particularly as Cas says, we still have a very tight labour market, and so I think it's the role of that person on the board and having the right person doing that job that's able to go out into the field and connect with people and really figure out what's going on. I think that's, if it's done well, that's one of the most important roles on the board.
Thank
Gillian,
you.
can I add one thing to that? Just because it's very timely. It happened earlier this week. It's not a UK proxy fight, but it's in a different jurisdiction. The CFO not only argued against the activist claims and cited any one of a number of reasons. One of the more interesting avenues that they applied for defense was that their employees, and they got a survey done of their employees who also objected to the activist claims. And I've not seen that before. I was kind of surprised. It was an interesting perspective. So it's not a company with a huge shareholder employee base, but didn't matter. The fact that 72% of their 600 employees were opposing the activists in claims 1, 2, and 3 was a different approach to this. And I wouldn't be surprised if we saw companies go down a similar route here and in other jurisdictions.
That's an interesting take on employee engagement. Thank you.
Definitely.
And I'd like to just sort of build on the point you made about cost of living crisis. We're just publishing some research on that, and we certainly saw a strong focus on REM. And going back to this year's AGM season, we do expect that sort of focus on how employees are being treated and the treatment of the executive directors, and I think that sort of neatly ties that knot of the S in ESG activism. We are just keeping an eye on the clock, so could we pull up the chart, please, Belle? And really just tying this discussion to a close. One of the things I've sort of can summarize this as beware of the gap, or mind the gap, because that's the gap, the chink that activists find. And I think as a board member, just being aware and understanding where the gaps may be is really important. One of the points we've made very clearly, activism is now multifaceted, but old disciplines pertain. And by that we mean know your share register, and also know your stakeholder map, because the two are coming together in terms of activism. The second point, as a board, be very clear what you or the company is committing to. And by this, I mean financial targets, but also in terms of promises, expectations regarding climate change, for example. Be very clear what you're committing to the market, understand those commitments. Thirdly, make sure that there's alignment, that you, the board, and the management team are aligned behind those commitments. Where there are gaps, that's where activists will sense the opportunity. And by gaps, I mean both in terms of composition, that you've actually got a team that sort of supports the strategy and has the skills to deliver the strategy, and equally at board level to oversee the strategy, but also how you communicate in the market. The fourth point is one that I know has been addressed, and I can't stress enough. Ensure as a board member that you have effective engagement and communication with shareholders and stakeholders at board and management level. So this is 2 tiers of engagement. And we haven't really mentioned listening, although we haven't used the verb to listen, but actually listening and knowing what your shareholders think and what your stakeholders think, tremendously important. And we certainly are seeing a big shift in boardrooms to be spending more time reflecting on the feedback, but also board members directly getting feedback from shareholders and stakeholders. And then the final piece, and this comes back to, by preempting activism, we're not saying ignoring it. We're absolutely not saying ignore activism, quite the opposite. It's much better that you as a board undertake the heavy lifting that needs to be done, rather than that you're compelled to do so by an activist. The consequences are likely to be very different if the activist is in the driving seat rather than you, the board. And for us, preempting is very active. It's understanding where the company's going. It's understanding what you've committed to deliver, and it's understanding what needs to be done to achieve that. And where there are gaps, either in valuation or in terms of delivery, it's moving to close those gaps. Steve talked about capital allocation, and I think that's one dimension. Cas talked a lot about the environmental expectations as well. But you as a board need to be on top of this, and if heavy lifting needs to be undertaken, it really lies with the board and shouldn't be driven by the activist. And then our last point is expect activism. Just anticipate that it will come, however good a company you are and however good times are. Activism is a reality. It will come, and you'll be better prepared if you've rehearsed for an activist intervention. So these are our sort of 5 takeaways, which I think wrap up much of the discussion that we've had with Steve and with Cas. And I'd certainly like to thank you and our listeners, and both Steve and Cas for their excellent contribution today on a really topical but quite thorny subject. I'd like to just move to the next chart, Belle, please, before we close. And this is future webinars and activity by Fidelio. We will be publishing our cost of living report, and in particular what this means, the cost of living crisis for the board, very shortly. We have a chair breakfast next month, the social contract and board accountability, with the very impressive Rector Lucy Winkett of St James Church, Piccadilly. We also have, on a rather different note, autonomous driving possibilities and limitations, looking at the governance and regulation of autonomous driving, a webinar in March. I'll be speaking at the a conference on climate change and extreme weather events, and looking in particular at assurance and the assurance that the board needs in this context. And finally, we have a webinar on the regulation, the challenge of regulating and the governance of AI. So a whole a sort of cornucopia of topics, but very much around the sort of governance and oversight. But back to today, I'd really like to thank our speakers. I think you've shed a lot of light on a very difficult subject. We will share both the recording, the charts, and some of the recommendations that were made, including the link, for example, to Chapter 0 and to the Wirecard references. Many thanks. And as ever, if we, Fidelio, can be of support to you and your boards, building that board capability, please don't hesitate to get in touch. Thank you all very much. Thank you. Goodbye.